Hello, I'm Kate Thorley and I'm joined with our lead portfolio managers Oscar, Catriona and Matt for another edition of WAM Vault. And we're going to address some of the questions that shareholders sent in. So Catriona, I might start with you. How are you positioning your portfolio and what's changed since we did Vault in November 2020?
We've transitioned more of the portfolio towards really reopening winners. So we've obviously since then had the vaccines announced. We've added a number of stocks in terms of sectors such as travel, media, housing out of the US, for example. But we still retain a number of those longer term structural winners as well in areas like health and wellness, digitisation of payments, and automation. So a bit of a balanced approach in terms of the portfolio, but expecting, as economies reopen, a lot of those shorter term wins to come from those reopening plays. And Matt, from a big cap Australian equities perspective?
Yeah, very much like Catriona. I mean, the big change we've had, we've really went overweight resources last year as China put their foot down for the credit cycle. That's played out now. Now we're flipping back towards financials. Energy, we still think it's got some legs in it, but very much along Catriona's lines of positioning for the recovery from the recession, economies coming back and that output gap closing, and that's where we're really positioned at the moment.
And Oscar?
It's pretty much the exact same. Well, the first half of the year we did quite well out of some sectors such as e-commerce, agriculture, healthcare. Those companies are really benefiting from COVID. And then as, of course, the Pfizer vaccine got announced in November, we had to quickly change the portfolio. So guys did a great job in the team in shifting to those cyclical sectors such as financials, beaten up sectors like aged care, construction services. And I guess from my perspective, what we've seen is it's been a rapid shift away from growth to value, but it's still the valuation difference between these companies are the highest it's been in 50 years. So there's still a long way to go, particularly if we start to see rising interest rates.
That's great. And Matt, sort of looking more slightly longer term, one of the questions that shareholders were interested in was around inflation. What are your thoughts around inflation?
Yeah, I think the market's pretty well priced in correctly at the moment. So you're looking at, in the US, around 2.5% is the break-even rates in the US, so 2.5% inflation. I think that's right. What we're looking for now is events to change those expectations. So we're looking at the closing of the output gap. So that's the difference between where the economy should be and where it is now. If that closes faster, that will push up inflation expectations. And also, generally the stimulus out there at the moment, so that's a real driver at the moment. But I think for investors, it's pretty well priced in the market at the moment. So unless there was an inflation shock, which I don't think there will be, I think the market has it correct now. So what we're focusing on now is any event to change those expectations, not around, will inflation hit 2.5%? That's in the market. That's not the conversation. It's around events now which will shape the shift in that, either down or up, and that's what we're focusing on at the moment.
It's been fascinating in the small cap part of the market. We've done the rounds and been across Australia pretty much for the last 2 or 3 months, and it does feel that every company you speak to has cost pressures at the moment. I think the best example we've seen is Tassal, which is a salmon producer. I didn't know this until COVID happened, but they used to export 90% of their salmon in a passenger jet. So obviously with international flights effectively stopping, they've had to go to the sea, and that's a cost of 11 times higher than their normal freight costs. So I guess from our perspective in small caps, looking at small cap industrial companies, we really need to pick those companies that have the ability to raise prices to offset these cost pressures.
And that really is a phenomenon that we're certainly seeing globally. I mean, every day when we're talking to a company, whether they're in the US or Europe or the UK, certainly, we were speaking to one this morning that was complaining about polyethylene pipe. We've seen lumber complaints, freight, as Oscar's saying. So it's daily they're talking about these pressures. At the moment, most companies are saying it's totally fine in terms of passing that on. And a lot of are taking that view that it is transitory. So it is a key watch point, and it is a factor we're considering and really thinking about the companies in terms of whether they have pricing power if it does not prove to be as transitory as the current assumptions are.
And I guess that's the important thing. Inflation will dictate monetary policy. So the inflation is very important to watch because that will ultimately determine the interest rate hiking cycle. So that's why it's so important.
And just thinking about now the tech sector, it's obviously had a fantastic run up until more recently. Oscar, perhaps starting with you, what are you seeing in this sector?
Yes, speaking from the Australian perspective, I think we've really been able to differentiate the winners and losers in the technology sector. I think there was a period for a number of years where if you're a company that had pay at the end of your name, it seemed to get a huge re-rating and you trade at 20 times sales or something like that. So it does feel like those days are sort of coming to an end. There will always be opportunities, but if we look at the technology sector in Australia, I think the best example of a company that's done well through this period is probably Xero, which is the largest one. But it's got such a high level of recurring revenues. It's a SaaS-based business, and it's had very low levels of churn. I think I've been surprised at how resilient the business has been through here, and really confident around their market share growth that they can get in the United Kingdom and Australia and the US over time.
Great. Catriona?
Yeah, look, I think back to the point around interest rates, this has been obviously a key issue for tech stocks in terms of duration assets, discount. You've had interest rates coming down for a decade, inflating prices of some of these tech stocks, particularly in that concept end of the market where they don't generate any earnings. As Oscar said, they trade on enormous multiples of sales, and we've seen some of that hype come out of those share prices. When we're looking for opportunities, it's really in businesses that actually do have valuation support, and we certainly can see a number of pockets that are interesting, and a number of plays in the tech sector when we look globally. But it's certainly nowhere, not at all in those concept stocks where, they don't generate any earnings. And it's really, whether it's in automation, digitization of payments, these are trends that we think, have some longevity, but also you can buy stocks with, significant valuation support. So I think it's become a lot more nuanced, and you really got to, pick those individual stocks, not just buy any tech stock. As Oscar said, with whether it's pay or software as a service, you can bring out there. So I think it's a bit more nuanced right now.
So Matt, there's been a lot of headlines around resources and a so-called resources super cycle. What are your thoughts? Is there a resources super cycle?
I'd argue no. Resources, the primary driver of resources is China. They consume over 50% of copper, world copper, 70-80% of iron ore. What happened last year when the COVID hit, obviously that was the centre of it, the Chinese government immediately went and ramped up credit origination, infrastructure investment. It was huge, the amount of stimulus they put into the market. So that drove commodity prices. And then you had supply issues around, especially in copper. Latin America has been, hit hard by COVID. So you've had supply side issues and then stimulus within China driving this cycle. It is not a super cycle in my view. It's really the boom bust cycle we see in China all the time. They put the foot down and then they pull it back, and they're pulling it back at the moment. So I think if you're going to play resources from here, you really got to be specific around different commodities. Iron ore, I think, is pretty well done now. Still will be elevated, but I think that trade is very much over. But things like manganese and alumina, aluminium, those things haven't rallied yet, but the spot prices have. So I think if you're going to position, you're going to play in that space.
Now, Catriona, we actually had quite a few questions from shareholders around the US market. You've just come through the reporting season. What's been interesting out of that market?
Look, speaking to companies on the ground, certainly, and seeing how the earnings they reported through the recent reporting season, certainly demand is coming back strongly. A lot of companies were pretty conservative in terms of willingness to put out guidance, etc. And you saw, I think it's about 88% of companies beat. So a significant, level of beats to conservative guidance. What was interesting was some of the share price reactions were pretty muted despite this. So, and look, in some cases that gave us, opportunities in companies where we thought that is a cracking result. The share price hasn't moved, and we were able to buy more. I'd say, talking to management teams, there's no doubt, demand is coming back. There is these supply issues in certain pockets, whether it was semiconductor chips causing issues for, ability to roll out or manufacture gaming consoles, cars, computers themselves. So, there are some supply, temporary supply constraints. But generally, on the demand side, companies are very positive. Supply, despite those hiccups, is starting to come through. And then you've got this backdrop of consumers generally being pretty cashed up in a lot of cases because they've been locked down, unable to spend their money, and so a lot of pent up demand. So, the backdrop for the economy there is pretty strong.
That's great. And Matt, over to you on the banks. This is always a common question for our shareholders. What are your thoughts on the Aussie banks?
So the banks actually traded really well through COVID. So it was predominantly through government support. So the RBA, APRA, basically all came in and gave them support, gave them cheap funding. The cheap funding's still in place now. Last year, it was in March, April, they struck huge provisions on the basis of COVID. Deteriorating the economy into a state where there's a lot of defaults. That's been wound back now. So the banks are well capitalised. They're going to release provisions over this year. There's going to be a lot of capital management too. So we were fortunate enough to catch up with a few of the bank CEOs, and very much on the table is how do we return some of this capital to shareholders. So I think CBA will do big off-market buyback, handback franking. NAB will do on-market buyback. So they're in a great position, and also the headwinds, which are low interest rates, are starting to unwind now. So the big effects have been felt already, and in 22 and 23, they'll start to turn to tailwind. So it's actually a very good spot for the banks at the moment, but the easy money has been made. The last 10-15% is probably about left in them at the moment.
And Oscar, another question from investors was around if interest rates do start to rise, what sectors here in the Aussie market do you see?
Yeah, well, very, very similar to Matt. I mean, banks aren't traditionally a sector that we hold in sort of WAM Capital, WAM Microcap, but the outlook for the banks is very strong. Interestingly enough, I caught up with one of the largest non-bank lenders yesterday in Melbourne, and they were saying that the number of impaired or problem loans that they have on their books right now is actually lower than what it was pre-COVID, which is incredible when you think about it. So I guess, the rising interest rate environment, that should boost net interest margins. And for these reasons, we've got large positions in the portfolio in MyState and also Virgin Money UK, which really should benefit from an improving UK economy.
Thanks so much for your time, and thanks so much to our shareholders for your questions.